we're going to talk about the relationship between pairs. When you start trading, you most times do not know the reason why you are picking a particular pair. You end up seeing people picking GBPUSD or EURUSD or GBPJPY. You Most times people don't really know why they pick those pairs to trade, but at the end of the day, there's an implication or there's a proper way of picking a pair. So we're going to be covering that, the relationship between pairs. So we're going to start with the pair that almost everybody is conversant with, which is the GBPUSD, EURUSD, and then so many people don't know about the dollar index, which is that's the actual dollar. So the relationship now, we want to define the relationship between these three pairs. Dollar in itself is not really tradable, but you see GBPUSD and then EURUSD are pairs that are actually tradable. So I want to tell you guys the relationship between them. GBPUSD is the other name is pound. That's the currency that is being used in the United Kingdom. Euro itself is the currency that is used in Europe, in countries like France, countries like Spain, and the rest of them. So most of the European countries actually use euro to trade. So generally, there's a relationship between GBP, which is the pound, and euro. They usually move together. They correlate. Okay. So how to now pick pairs is, if you want to pick a pair that, let's say, you want to use on GBPUSD, that means you're also supposed to be looking at the EURUSD. That's simply what it means, because you see traders only picking EURUSD, or they are picking GBPUSD. So when you are trading, you're supposed to look at these two pairs together. Now, the XY is the same thing as USD, which is the dollar index. Now, if you look at it, GBPUSD is tied with EURUSD or the XY. That's what it means. So what it means is that whenever EURUSD or GBPUSD is doing something like this, it's creating higher highs, or let's say when it is going up, let's assume this is GBP is going higher like this. So let's say this GBPUSD. What you tend to see is, you see EURUSD, you see the XY, doing this. DXY will be going down. So what it simply means is, anytime you see either GBPUSD or EURUSD going up, what you see is, you see that the XY is moving down. That's simply what it means. Whenever you want to pick a pair to trade, you should make sure that these pairs make sure that you understand the relationship between the pairs that you are trading. That's one mistake that a lot of people make. So this is one pair that you should pay attention to. So anytime GBPUSD or EURUSD is going up, you tend to see that the XY is coming down. So how do you use this to trade? Usually, the dollar index, they usually say that dollar is king or DXY is king. The reason is because if you want to trade GBPUSD now, you have to be looking at the dollar index in itself to make sure that it is aligned with either GBPUSD or the EURUSD. Let's assume you are ready to start selling let's assume you are ready to start selling, or you are ready to start buying your GBPUSD or your EURUSD. If your DXY or your dollar index is not ready to start buying, it means that your setup is not ready. So the only time you are supposed to either buy or sell GBPUSD or EURUSD is when your dollar index is ready. I don't know if I'm making sense. So you only buy or sell EURUSD or GBPUSD when your dollar index is ready. That's simply what it means. So you don't just pick pairs randomly. You don't just pick GBPUSD alone and just trade it, or you pick EURUSD alone and trade it. So you have to correlate it. You have to look at two of them. You have to look at the pairs together before you trade them. I don't want to ponder too much on this. I just wanted you guys to have an understanding that when picking pairs, you have to make sure that the pair, you understand the correlation between these pairs. I will show you another set of pairs that are related. Another set of pairs that are related is you have the GBPJPY, you have the EURJPY, and then you have the JPY basket. So this JPY basket stands for GPY. So the same way we see that the dollar index stands for the XY, the JPY basket stands for GPY. Basically, that's what it means. So the same way, anytime your GBPUSD, GBPJPY is going down, let's assume GBPJPY is going down. Let's assume this is GBPJPY, GBPJPY, because anytime GBPJPY is going down, EURJPY will also be going down. So it's the same thing with anytime Euro USD is going down, it means that GBP USD will also go down. So GBP JPY and Euro JPY is going down. Your JPY basket will be going. That's what it means. So this is your JPY basket. So that's what it means. Anytime your GBP JPY or Euro JPY is going down, just be rest assured that your JPY basket is going to be going up. That's the relationship. The next thing that we are going to cover, which is very, very important, is our trading time. Let's call this trading. So basically the trading Q zone is these are the times where you are supposed to be trading in the market. Because if for a beginner, one of the things that I suffered with is in the middle of the night I'll be trading, yes, when I'm supposed to be sleeping. And when you are trading not in line with your Q zone, what tends to happen is you discover that the market is usually very slow. Market doesn't really move. The market doing something like this, you are seeing a clear signal for it, market either buy or sell, but you see the market consolidating like this. At the end of the day, you'll be so frustrated. Not only will you be frustrated, it will make you very emotional because you are not sure where the market is going when you see the market consolidating like this. That's why we say anytime you see a market that is consolidating, you should allow it, just let it go. So the times we are supposed to be trading are usually during our Q zones, our trading Q zone. So this in a way is going to help you to be relaxed. So if you are not within this Q zone, you just relax and not want to take trade. So we have two Q zones. Our first Q zone is the London Q zone. This is the London Q zone. Now the London Q zone starts between 7 a.m. Nigerian time to 10 a.m. Nigerian time. So you see, so the times you're supposed to be taking your trades for the London Q zone should be between 7 a.m. and 10 a.m. Nigerian time. Some people argue that you could extend it to 11 a.m. But for the sake of prudence, 7 a.m. and 10 a.m. Nigerian time. Please take note, Nigerian time or West African Standard Time. That's +1. These are the times you're supposed to be taking your London Q zone trade. Now the second Q zone we have is the New York Q zone. The New York Q zone starts between 1 p.m. Nigerian time to 4 p.m. Nigerian time. Some people still argue that you could extend it to 5, but I would suggest that you go with 1 p.m. to 4 p.m. So that's to tell you that if you are not within this time, you are not supposed to be trading. But it doesn't mean you should not be analyzing your chart. All things being equal, if you want to trade during your London Q zone, it means that you're supposed to be up at least by 6 a.m. in the morning. So you're supposed to be up at least looking at your chart, analyzing, looking at your setup. But you don't take that trade until it is within the London Q zone. That if you want to trade the London Q zone. Now, some people will not want to trade during the London Q zone because their strategy is not in line with that. There's a strategy that will encourage you to trade during the London Q zone, and then there's a strategy that will encourage you to trade within the New York Q zone. So if you are not a London Q zone trader, you could just wait for your New York Q zone. So between 1 p.m. and 4 p.m., you should just wait and take your trade. So that means your analysis is supposed to start at least an hour before the Q zone. So if you are trading your London Q zone, anything 12, you're supposed to be on your chart looking at the setup, seeing how it is going to unfold and all that. The Q zone is actually very, very important. It's very important to trade within the Q zone because number one, you won't face too much consolidation in the market. The market will not be consolidating during this Q zone. If you're expecting a buy, you see that the market is giving you those very nice clean setups within the Q zone. If you're expecting the market to sell, these are the times when the market will be very, very impulsive to get. So during your Q zone, the market is usually very volatile. That's what it means. And apart from that, there's something we call spread. Spread is usually very high when the market is not within the Q zone. So just imagine you want to take a trade maybe around 1 a.m. The spread is going to be very wide, you get. But when you take it within the Q zone, your spread is going to be very, very little. I don't know if I'm making sense. Then also another thing that you should know is there are peers that encourage you to trade within this Q zone. If you want to trade during the London Q zone, the pairs you're supposed to be trading should be Euro USD and GBP USD. You should be very focused on these pairs when you want to trade the Q zone. Yeah, during the London Q zone or the New York Q zone. But yeah, you get. So it's very important. It's very, very important. There are so many pairs out there. There are so many pairs out there. Earlier, I made an example with EURJPY, EURJPY, and GBPJPY. Now, this pair here is encouraged that you trade them usually only during the London Q zone. The market will not really move within your New York Q zone because if you notice, New York stands for USD. New York is like the currency that is being traded within New York, right? Yes. So if you trade your EURJPY or your GBPJPY within your New York King zone, you discover that the market is going to be a little bit choppy. You see, it's going to be going up and coming down. You'll be frustrated. But if you want to enjoy it very well, trade them within your London King zone. But for this class, just have it at the back of your mind that EURJPY, GBPJPY is very good for London. Euro USD, GBP USD is good for either the London King zone or the New York King zone. You don't really have any issue with that. So I think we are done with this. So let's go straight into what we actually have for today. Though this one is going to be very brief. If you guys remember, during the last session, we spoke about the OTE, which is the optimal trade entry strategy. And if you remember very quickly, what we covered is if we have a market structure that is like this, what we want to do is we are going to use our Fibonacci retracement tool to measure between this trading range like this trading range like this, low to high when we are bullish. And then we want the market to retrace into either this 0.62, which is OTE1, or 0.705, which is your OTE2. So when the market retraces into this either OTE1 or OTE2, you're going to see a reversal pattern here that will make or want to push price higher. So this is the strategy I showed you guys the last time. So what's going to happen is I'm going to go to the live chat and show you guys the trades that I took using this OTE strategy. So let me go to the live chat. But before then, if you remember, I told you guys that the first step is, I don't know if you guys can remember, what did I say the first step should be in trading the OTE? Because I think I mentioned like 5 steps or 4 in trading the OTE. First step, I said we should, number 1, know our structure on the higher time frame. So after finding our structure on the higher time frame, we should go down to the lower time frame. And the time frames I said are very good for your OTE. I said we have the 1 hour, the 2 hours, and then the 4 hours. These are the 4 time frames that are good for trading OT. So here, this is GBP, this is GBPUSD. So let's start from the higher time frame. Let's start from the weekly time frame. So let's assume this did not happen. This particular candle did not form because I taught you guys the strategy, I think last week. So let's just assume this did not play out. This candle did not form. If you've been following me, I told you guys that there's a reversal pattern. There's a reversal pattern. So if you see a situation where the market closed with a weak to weak and it has not taken this out, what it should tell you is there's a very high chance that market will want to come and take this low. So you see, market took out this week here. This is a weekly time frame. So you should be expecting that in this situation, this week should at least give us at least a form of sell-off. Okay. We should be going into the week with the expectation that market is supposed to sell. So what we're supposed to be doing is our OTE should be aligned in such a way that we are going to be looking for selling opportunities. So now let's go to the daily time frame. We actually don't have to go to the daily time frame, but we could go to the daily time frame for this. Monday being the first day of the week, market did the same thing, took out this candle here. So we're expecting that at least price should come here. So this is Monday. So we should be expecting that price should at least come down. So moving into Tuesday, our expectation is, okay, now let's sell. Even on Monday, we should be expecting that market should sell. So I told you guys that to now streamline our OTE, we should be using 1 hour, 2 hours, and 4 hours. So now let me go down to the 4 hours time frame. If we have anything that is in line with, okay, so now this is Monday. This is Monday. Okay, this is where the market opened. Now, do we have a clear structure? I told you, after finding your structure, the next thing is you are supposed to know or define your trading range. Now our trading range is here. You see, between here and here, because we want to sell. So this is our trading range. I told you guys that anything that is above the 50% is our premium. Anything below is our discount. So we should be looking for sales as soon as price moves into our premium area because we are trying to sell. So now let me use the FIB show you guys. So using our FIB, can you remember the OTE I told you? This is our trading range between this high and this low. So just look at it. This high and this low is our OTE, is our trading range. So now see the way price moved into this OTE1. And then look at it sold off. This would have been our take profit. You see, look at the very massive rejection it gave the very moment it entered OTE1. So this is a trade I actually took this trade. This was the target. So another thing I want to also mention is the fact that when it comes to this market, you don't have to trade every day. Trading every day is more like you're exposing yourself to the market. And the more you expose yourself to the market, it means that you have a high chance of losing money. So you see your trading range between this high and this low, you have your OTE1 and your OTE2. So this would have been your entry here because after this rejection here, you have just entered here, your stop loss will be here. and then just target this, you would have gotten a very, very good trade. It's a trade that actually took. So this is one trading opportunity that would have had it been we took a trade. This is another one. You see, between this high and then this low, this high and then this low. You see the way the market rejected, and this would have given you a very good trade also. So basically, on this particular day, on this particular week, would have had two solid trades that deliver to our take profit. This was supposed to be the take profit. Here is supposed to be our stop loss. So we would have had two very excellent trades if we had used the OTE this week. So this trade was on Monday. This trade was on Tuesday. So between Monday and Tuesday, we would have gotten a very solid trade, and each of them is like 1 to 2, 1 to 3. This one should be 1 to 3, 1 ratio 3. This one should be 1 ratio 2. So you see, this is a very, very solid trade that we took.